Hello and welcome to our latest Money Show Money Masters podcast segment. I'm Mike Larson, editor-in-chief at Money Show, and today I'm pleased to welcome Jonathan Hoenig, portfolio manager at Capitalistpig Hedge Fund. Jonathan, how are you?
I'm great, Mike. Thank you. Thanks for having me.
I always love that name. I think it's a great a great way to stand out in this market, right?
Yeah, well, look, I mean, to me, being a capitalist or being a capitalist pig is a good thing. I take it as a term of endearment. I think, we need a little more capitalism out there. So I've had the name of my firm and at my website, capitalistpig.com, for about 20 years now, and I'm glad that it sticks.
Yeah, absolutely, absolutely. Let's start with the big picture here. We had a tech-driven market clearly for most of the first half. Here in July, we've seen this kind of powerful rotation where value, small caps are sort of reasserting themselves. What do you think is driving that? And do you think this is just a blip, or do you think this is maybe a trend shift that we're going to have to pay attention to for the back half of the year?
No, Mike, I do think we are seeing a changing of the guard. My whole perspective on the markets is, and it's the name of my book, price is primary. If you're talking about the market, if you're analyzing the market, you should be looking at the market and at the market itself, at price action in the market. So, too often as investors, we are almost have a paralysis by analysis. We're looking at fundamentals, we're looking at earnings, we're looking at insider buying and selling. So I'm looking at price. And because, as you said, so many other types of names, I mean, my God, we've talked about those Magnificent Seven for years now. Wonderful companies, great future, I'm sure, for the technologies, but you can't deny that, names like Philip Morris are breaking out, or small caps of values. So Ford stock has been breaking out to do 52-week highs. So that's what always interests me, is what's doing well, but not necessarily being talked about, and the types of names that would surprise most people. And I think if most people, you said, well, Ford is a lot stronger than NVIDIA, they'd probably be surprised.
Right, absolutely. What do you think's driving this? This kind of came, I don't want to say out of left field, but just the power of that rotation. So I'm wondering what are some of the catalysts there?
Well, look, I mean, one is, I think, first of all, as a technician, you have to say, why ask why? Too often we look for reasons why a market's moving and try to come up with some justification. I mean, in the book, I talk about, gold, which was up every year from 2001 to 2010 or 11. And every year there was a different reason. It was like the war in Iraq and insider buying, and there's always some reason. So, you really want to focus on price. One obvious reason, in my opinion, is just relative undervaluation. Value stocks, small cap stocks, international stocks, they've really just been simply thrown out in recent years. And, we've both been doing this long enough to remember where a time when these were very much in fashion. People were paying a valuation premium for small caps, for value international. So they're not anymore. So the fact that they're doing well in price, and the fact that they're legitimately undervalued relative to small caps, to me is worth noting.
We're definitely going to unpack kind of each of those groups in a minute, but I did have to ask you, you step back and look at the big picture environment. We're probably looking at maybe a Fed cut or two, maybe even three coming in the back half of this year, early 25. Inflation's still probably too high for Main Street, but it's nowhere near the highs, Wall Street was concerned about in 22. Do you think that's a fair kind of summation, or, do you think that more benign environment is going to be good for the markets, again, as we head into the back half?
Well, what's the fundamental question of what's next for inflation? I really try to take a look back and study history. And I've always been a student of market history, and I think you really have to be, and put myself back and, well, what were we thinking in 1977, 1978, 1974? And, in the mid 1970s, they really thought that they had inflation kicked. The Ford and even the early Carter administration, because interest rates had fallen, by about a third. And the thought was, we've got inflation. And then it was 3 or 4 years later, it kind of turned and roared around. So to me, at least right now, the bond market's showing pretty mixed signals. And
Yeah.
I'm taking a cue from one of my, trading mentors, Jesse Livermore, who talked about, there's a time to go long, a time to go short, and a time to go fishing. I think now's a great time to, as they say, go fishing, keep a lot of options open, because the tea leaves and the crystal ball, I think, is quite muddy when it comes to inflation and rates in particular.
Got it. Fair enough. Pivoting to the other topic that I think is kind of on everybody's plate here, given all the developments in last week, politics and markets, right? How do you think markets are going to handle what looks to be now a Trump-Harris race? And there are implications for investors, again, in your opinion, for a Trump victory versus a Harris victory?
Well, markets often will surprise us. I mean, as I recall, oil stocks did extraordinarily well under the Obama administration. So, that's the thing about markets is that, and why I think you have to trust price is that oftentimes, or even something like the alternative energy stocks have been annihilated. You think, well, what about the subsidies? What about all the friendly? So, you really have to think to trust price and not necessarily what happens. I mean, there's no statistical data that I've seen that says the market does better under one administration over the other. So, I think now it does worry me in particular that, former President Trump seems to be oftentimes antagonistic to free or to business leaders who I represent, Mark Zuckerberg, or who I respect, I should say, Mark Zuckerberg among them. So, I think whoever is in the White House needs to take a cue from the second half of the Carter administration. By the second half of the Carter administration, inflation was so bad, Jimmy Carter cut taxes, he cut regulation, and that really spurred that Reagan revolution. So that's what we really need to, I think, set the economy on fire. Less government spending, and that doesn't seem to be present in a lot of politics, writ large right now. So wait and see.
Got it. Gotcha. Let's pivot to some of those sectors and some of those names and groups you've been talking about. I mean, you were on Varney & Co. recently, and you kind of highlighted the, quote, anything but exotic names. It was things like BCE and T-Mobile, Verizon, and so on. And you were saying, investors should probably be looking at those instead of the ones everybody talks about, Microsoft, NVIDIA, whatever. Why is that the case? And do you think, again, that's going to be a longer-term thing we're going to be dealing with here?
Well, AT&T, which is kind of emblematic of those old school telecom names, if you will, has really been a strong outperformer after, I don't want to say years. I haven't looked at the chart recently, but it feels like decades of underperformance. That's a name that it used to be in everyone's portfolio. It's extraordinarily out of fashion right now, and it's a relatively small company. But in the last couple of weeks, it's hit a new 52-week high. So, to me, for most people, when they are looking for stock ideas, they're looking at the list of 52-week lows. That's where they say, well, I want to buy a stock when it's low. So they look at stocks that are hitting lows. These are weak names, fundamentally weak names. So for me, when I see a stock hitting a 52-week high, look, it doesn't mean it's a guarantee that that trend necessarily continues, but you want to buy assets. I believe they're doing well. So some of those names you mentioned, the other telecom names or the tobacco names in particular with Philip Morris, British American Tobacco, BTI is one that it's on my list. So, I think you want to kind of, as they say, go where the action is. So the fact that the sectors are doing well is reason, I think, to look at the sectors overall.
Got it. Got it. One of the other things that you talked about coming into this year was again, a contrarian idea, and that's emerging markets. I think EMDM was one of the ETFs you mentioned, and that focuses on sort of democratic or more democratic EM countries. How do you feel now that we're sort of at the mid-year point? You still like that group, and why or why not?
They were very strong. They've come off a bit, given the strength of the dollar or just given weakness in emerging markets writ large. It's not leading. So, for me, putting new money to work, I want to focus on what's leading. But I still think the story is not yet written from emerging markets at all. I mean, again, these are assets that used to trade at a premium to the S&P 500, as a premium to large cap, even large cap technology. And they're so extraordinarily unpopular right now. I do think that if you are an investor, and so much of it's about knowing who you are. If you're a trader looking for something that's going to move 10 or 15% in a week's time, this is not. But if you're looking at assets, I believe that are legitimately undervalued, emerging markets and some of the names that have been mentioned on Varney, I think are a great place to be putting new money to work.
Got it. And one other group that you mentioned that I think clearly we've seen, even relative to the S&P has done very well is gold, precious metals. GLTR, I think was the ETF you mentioned. How about that? Do you still, we had the big breakout, we've had a little bit of a pullback. Do you think that sector still has more promise this year?
The thing about markets, and Mike, this is they have all the time in the world. And gold is, you said, look, at all-time high is bullish, and I'm certainly bullish on gold. Silver, actually, my personal biggest holding as an individual happens to be platinum, PPLT, which has underperformed pretty dramatically. But gold is the kind of asset that could make us wait 6 months, a year, even 2 years. So it's why position size is so important. This is what I write about in the book. What I'm going to talk about at the session as well is, it's not even picking the right asset. It's how much do you have? When do you add? When do you cut? So I think now is a great time to have gold as part of a portfolio, but not the only part of a portfolio.
Got it. It's funny, before we started, we were talking off camera a little bit about how, despite some of these opportunities, generally speaking, it seems to be a little bit thinner picking kind of environment, right?
Yeah, I mean, you don't always have to be fully invested, is my opinion. And I think there's an obligation, especially when you feel like you've got cash, cash sitting in your account. You say, what am I doing? I'm missing out on some opportunities. You can't invest in everything. You can't bet on everything. I think you have to really pick those individual particular points. And I do think there are opportunities to make money right now. But, I'm finding them a little more thin. And I'm, as I said, kind of borrowing from Jesse Livermore, very happy to kind of wait till those opportunities come up that I feel as if I just have to be part of. I think that's the way to be an investor or a trader. It's not just to wake up and say, oh, I'll buy any old thing. I mean, if that's how you feel about your hard-earned money, I don't know, maybe you have it too easy, but it's too hard to earn and to make to kind of be so frivolous. So wait for those few ideas that you really think you have to be part of. Platinum is one, but I want to see it back above $1,000 an ounce before committing more capital to work.
Got it. I'm glad you brought up some of the sort of tactical stuff that you talk about. I mean, you were recently speaking at a virtual money show event talking about, sizing trades and kind of how ways you can make sure you have a larger position in winners and a smaller position in losers. Any tips and tactics you could share here on this interview?
Absolutely. I mean, I think to me, that's really the kind of recipe for success. I mean, even the best investors, maybe they're right 55% of the time. I mean, we're not gods. No one's right all the time. And I think the secret, if you will, and I started trading on the floor of the Board of Trade in the 1990s here in Chicago, and I saw traders making money in soybeans who knew nothing about soybeans, knew nothing about corn, knew nothing about agriculture, but they knew how to trade and knew how to invest. So position size is where the rubber meets the road, and it's easy to have this stock, that stock. What often happens is people buy a stock and it goes up hundreds of %, but they don't make any real money because they have such a little position. And they probably took that little position because it was a risky stock. At the same time, they buy something like, not to pick on Walgreens, but Walgreens, which, seen as a safe stock, stable, S&P 500 company, down some, 50, 60% in just 2 years. So yeah. They often, are erratic about that position size. So one of the things I talk about in the book is having what is called a trading unit, that standardized, consistent position size. Every time you're putting new money to work, you're starting with that same, let's say 5%. Cut the losers, let the winners run and add to them. That's how you make money over time, in my opinion.
Perfect. As we wrap things up here, I mean, obviously we're speaking, one of the reasons is because you're going to be joining us for the Money Show Traders Expo in Orlando in October. We're a couple months away, so it's hard to pin these things down, especially if you're technically inclined. But any, sort of sneak peek you'd want to provide of what you think you're going to be talking about there?
Yeah, I mean, I think, unfortunately, the market is so frustrating for people because they don't have a coherent way to analyze it. Kind of one day they wake up and they're a technician, but they've really got a great feeling about the stock or they feel scared. So, it ends up being, I think, very distressing for a lot of people. And that's what I hope to provide at the talk is, the whole idea of the book is a coherent philosophy of how to understand the market, how to act in the market, when to add, when to cut, really how to manage those positions for profit long term, not centered around any particular name, technology, large caps, REITs, anything else, but markets writ large. So it's a coherent philosophy to succeed, as we say, not in this market, but in any market, anytime, now, in the future. So I hope to see everyone in Orlando and delighted to be part of it.
That sounds great. I think that's a great place to wrap up. Jonathan, thank you so much for your insights. Viewers, if you're watching this, you want to learn more from Jonathan, he is going to be joining us for that Money Show Traders Expo in Orlando. It runs from October 17th to the 19th at the Omni Orlando Resort at Champions Gate. Great time of the year in Central Florida. A lot of golf to be had too, in addition to some learning and education. So please do join us there. Jonathan, thanks again for your time. Appreciate it.
Thank you. Be well.